intraday. We kind of faded back here, but we're pretty
Well, so let's
elevated. I mean, we
let's
were above the
explain why you
14.
do these two. Sorry, before you tell us why we're elevated and
Yeah.
what this means, why do you look at the difference of the 3 months and the 1 month, and what do you see that telling us as
So
that stretch is kind of yanking on it? What's that
yeah,
tell
so
you?
we see near-term volatility expectations for 30 days or here, and then we see higher volatility expectations out of 3 months. I mean, that can only diverge so far before it creates a lot of strain, right? And when that's
Mhm.
creates strain, what it means it's going to snap back, which means the VIX is going to push higher. And that's when we see this yellow line drop below one, which is what we got back here on the 18th of December, right? So we're looking for periods when this is really elevated. We're saying, look, we're really pushing and really looking at very high volatility expectations outside in the next 3 to 4 weeks. And so again, we get stretched, and then all of a sudden you see, wow, institutions are as hedged as they've ever been, as reflected in skew. And you're like, man, maybe I should draw back my bullish fervor and say, look, I maybe need to temper some of my expectations a little bit, because what happens is when skew's this high, the market, you get the easy money. Yeah, we got the announcement this week. We got the kind of the pop in the market. And then you start to just grind, and
Mhm.
you're walking up the stairs, and then at some point you start to fall out the window. So it's done pretty good at forecasting a 5% correction from the high back here, a 5% correction from the high here. We got two 5% corrections. Now we're kind of resetting that again, looking for another 5 to 10% correction. Again, if we're higher today, that would probably push us above that threshold. Intraday, we were testing it. So, but
Well,
again, I mean,
I just was going to point out that the probability of us, when those two diverge, separate that far, the probability of the short term dropping lower at this point is you have
yeah,
this much room, right?
there's not much room, right?
Yeah, you don't really have that. That's probability is so low that you're going to see the volatility drop in the short term that it's going to propel itself likely higher. And uh, and I would compare it to like a tow rope, a good tow rope that has some spring in it. You
Uh-huh.
can pull and pull and pull, but sooner or later that back car, the towed car,
Yeah,
starts to move, and
right.
that's when you see the other car kind of jolt forward, and then they get going the same direction.
Or like
So
a Swiss ball. When you're sitting on a Swiss ball, you kind of roll back, you're okay. And then all of a sudden, you end
you,
up across the room.
that's right. You
Like I
cross
did
that
that on a
tipping
live
point.
session back in the day when we were doing education. My headset was on my head, and I'm across the room, and it just snapped back and smacked my monitor. Didn't break
That's
it,
that's hilarious.
but that's the recoil. So again, we're looking for volatility recoil, right? We're looking for it
Yep.
to come back in. We may have a little more, but the more we get up, we're more stretched. Just be careful. And we had potential. Again, we got a lot of stuff that can move the market. I understand why we're hedged right now, because there's a lot of executive orders. I mean, what are we necessarily going to produce from this? Potentially some good things, right? Tariffs, is that a good thing or not? It's higher taxation if we can't lower other taxes. Is that good for the economy? No. What's the short run effect on the market? Do you feel there's any certainty right now in terms of investors right now, as far as how we should feel regarding the slew of executive orders we've seen and the desire to kind of reorder or reshuffle the deck here?
Well, how is that anything but uncertainty?
Yeah.
If we're not following normal processes, I mean, normal processes give us outcomes we can have at least some expectation. And so if you do everything with executive order, the problem with that is therefore how you don't know how the outcome is going to be and what's going to be the pressure on the market. So I think just from the uncertainty level, that's going to force that through. And as far as the tariffs go, I mean, you and I have just been talking about this for weeks now.
Yeah.
Um, I mean, Jamie Dimon getting back in line at Davos or Davos, however you say
Yeah.
that. And I mean, originally he was like, tariffs are going to crush this super inflationary is a bad thing. And then it's like, well, it's a little inflationary, but it's good for national security, so be it. I mean, it's him kowtowing and buckling. It's pathetic. I'm frankly, but
Yeah.
the fact is it is inflationary. Period. End of story.
And look, when you look at the various, I mean, in the end, I mean, tariffs, the idea of them entirely passing through doesn't work out that way, right?
Right.
In 2018, 19, tariffs didn't really lead to higher prices per se. But we're in a very different scenario right now. But again, if we raise taxes, tariffs, there is going to be some degree of pass through. Some people are looking upwards of an increase in 1.4% inflation. It's probably, from my perspective, going to come in less than that. But just a heads up, we're going to be having a discussion later today at 11 a.m. Pacific time. I'm going to be interviewing my brother who's in Indonesia right now, starting a business he was actually going to start in the United States, but immigration issues caused him to not. But anyway, we're going to be talking about some of the buildup in manufacturing in Asia, and that this afternoon, and some of the dynamics that are playing out right now for Asian manufacturing, and maybe some of the impact of tariffs and the relocation efforts. So, but JP Morgan, I mean, financials had a great week. Higher interest rates, yield curve uninverts. Hey, they're making money out there. But so when we think about banks, Blake, I mean, the Bank of Japan announced overnight a policy increase, right? So they increased rates. Um, what's your thoughts on that?
Yeah, I mean, it's the first time that they've the highest rates they've been at since 2008. I mean, that's just, it's just flat out. That's what it is. Bank of Japan had the 20+ year experiment of being near the 0%, but this shift is definitely putting some pressure, uh, a little bit of pressure. It's not end of the carry trade, but a little bit pressure on the idea that maybe we're going to continue to slowly unwind the 20-some year carry trade. So as we're watching this unwind, this theoretically means that there's going to be less selling of the yen and borrowing of the yen to create that carry trade. But I don't know if the carry trade was super healthy against most currencies. And we saw the correction when they moved it before. So it's a tough call in the short term, but it is a big pivotal move from the very long-term big picture, I think. And the market just said, yep. And so the reaction was, okay. Like I said, so the difference of that 0.25 to 0.5%, and it's really a little bit lower than that, but it was minimal as far as the reaction because we kind of expected it. But it is significant when we look at the big picture from multi-years that it isn't slow, and they're doing it right, frankly. They're unwinding very slowly, very carefully, very methodically, because they know they have trillions and trillions of yen borrowed to create this super carry trade over the last 23, 25 years. So I think they're
And the
handling it.
last time they got to 0.5%, they went into recession. But right now, their expectations for inflation are actually have increased, like from 2.4 to 2.6 this year. They still think they've got mission accomplished on inflation going forward from them. But yeah, the reaction we got back here in July, the last rate increase was rather profound. We tried to see some selling on the news, and we just saw the dollar get bid against the yen, prices going higher. But this is certainly something to watch. I mean, if it does begin to break, and we're going to talk about oil, but we're also going to talk about interest rates a little bit because what Trump said this week. Look, if this does begin to break, the Fed is announcing next week. We'll have to see what happens. I mean, what do we start to steer towards? Again, the Fed funds rate is expected not to change. Does the Fed get more dovish? Do they get more hawkish? In light of what the Bank of Japan is doing, this could move this market. But for right now, again, it's kind of a nothing burger, pretty well priced in. But be careful, right? If this thing starts to break away, it could break hard. I don't know. What's your thoughts, Blake, on that?
Yeah, I would agree. If it does break free, it's going to break hard. But the pound gained against the yen, the euro gained against the yen, the dollar gained against the yen after their announcement. So it's really not. We're just not seeing
No,
the fear. So it maybe they did it. Like I said, it feels like they've
yeah.
done it correct. They've
Really, I
managed
mean,
it
it's
the
almost
right
no, I
way.
mean, a little bit of downside here. We reversed it overnight. So
Mhm.
again, I mean, that's a positive for the market, right? I mean, it
Yeah,
just shows that,
that
hey,
is.
those inflows that came in from yen to dollars to stocks or whatever, it's holding, which is a good thing. Now, there may not be the continued stimulus, again, as interest rates creep up, as money becomes less available, of definitely more of a hawkish statement by Ueda, but it certainly didn't seem like he was going to, they're ready to pop this thing in terms of the yen carry trade and let the yen strengthen substantially. I think they're liking the weakness in the yen. They're trying to kind of on the margin strengthen it, I guess. But inflation is becoming more of a concern, which they haven't seen for a really long time. But let's talk about the oil case. I mean, the bull case for oil. So we're talking about the idea, hey, are we going to see more demand? People are saying some of those executive orders were unwinding. Sure. I think a lot of the executive orders are probably helpful in terms of freeing up. I mean, if you're going to raise tariffs and we're going to have a short run of higher taxation, we better increase our productivity substantially. And the question is, how much of a mismatch are we going to see there? But for oil, I mean, President Trump just seemed to indicate he wanted to say oil prices need to go lower. But how do we do that? I mean, what is the mechanism for lower oil prices at this point if we're expecting growth to continue at this stage and even accelerate in 2025?
Well, and it seems to be that, are we going to go back to fracking and oil shale and push that? And it might be. There's going to be a lot of pressure that way. And I think the big one is whether, even if demand continues to go higher, are we going to see, in my view, the holdbacks, the things that have kept that from happening has been more about the leases and things like that. And that is one of the areas that he says, look, we're going to take care of that. We're going to reinvestigate all the leases and the permits to do, as Bogey and others say, drill, baby, drill. And so the production probably is going to increase. And even the EIA has a short-term production. You can see the implied stock build that this first quarter we expect major down, but then kicks right back into positive territory. That's a build of inventory, which would require higher production than demand. And right now, EIA has that forecast that the oil prices can go from about 80 back to low 60s. And the build is going to be building close to 1 million barrel a day, which is in excess of the demand.
Mm. Yeah, and that's the thing is, I mean, but we still, from my standpoint, like we still have a lot of. If we look at the EIA, this is the current inventory level. We're below the 5-year range. Now, this still incorporates a lot of COVID, where we saw big builds. We're still kind of outside of that just a little bit. And if we look at production, and we're kind of here at 13.5 ish. If we increase 1 million, that'd put it way up here. I mean, that is a huge and extraordinary move. I mean, Biden did put an executive order basically stopping a lot of offshore drilling. And if we try to pull that back, there's going to be lawsuits. I mean, the delay on this could be real. And so, again, if we see, okay, we're going to see a sharp rise in production of 1 million barrels and we're going to see stockpiles increase. And again, we still got to fill the SPR. I mean, there's a lot of near-term needs and uncertainty in terms of the supply. And I just look at what's called product depth right here, /ES. I talked about the net cost to carry on Wednesday. So if you want to know more about it, we're looking at the oil futures market. I'm sorry,
ES.
sorry, CL. Well, this doesn't look like backwardation,
Yes,
but I
it does
talked
not.
about this dynamic and why prices are falling into the future and why this is actually bullish. But right now, traders are saying, look, there's very strong demand for oil out here. The lease rate for oil that you have in your hand, you can lease it out. The net cost that carries profoundly positive at this stage. There's still a very significant potential shortage. But again, even if prices don't go up a lot, or even if they hover even around this kind of 65 area to 70 price range, it's not exactly bad for oil stocks. They make money at this range. Maybe we don't see 88 just by the threat of saying, Trump saying, hey, we need to lower oil prices and backing up with policy to do it. Again, whether we immediately see that effect or not, we might see in the near future, though.
Well, now I'm going to just take that statement you made and add to it and say, look, if they make a margin here and they know they're going to have less regulation, less restrictions on production, they're going to increase production. And so even if you don't want to bet on crude because you think it's going to fall down to 68, it might be a really good bet because of the quantity will make it up in volume, as
Yeah.
Lucy says, and betting on the oil production exploration companies. My feelings are the same thing about metals mining. Even if gold stays where it's at, even if copper stays where it's at and pulls back, you can still bet on those companies because their cost to shut down temporarily or start back up is cheap. And yet they can, as far as the metals mining companies, and yet they make margin here. So this is a great place for them to be at. It doesn't have to keep going higher for them to make significant money. And so we're seeing metals mining bottoming out, in my view. And even if even if metals are pulling back, they're going to be starting to see their production hold at these margin levels. And back to oil and exploration, whether prices go down, they still have margin and it will be made up in. They don't lose at 80. They don't lose at 60. They don't start losing until the 50s. And if their regulation is reduced, they might not even be losing at 50. They
Yeah.
might be able to go down to sub 50.
And energy has been a profound drag on S&P earnings now for years, right? I mean, they cut a lot of production plans or expansion or CapEx plans in 2020. Natural gas had planned on cutting expenditures because the gas market was terrible. But then all of a sudden, with COVID hitting and the lack of supply, the lack of demand there, we're in a position right now where again natural gas is trading at 380. If we're starting to see more export opportunities of liquid natural gas to Europe, for example, they may not like it if we're tariffing, Canadian oil at 25%, if we're taking away Venezuelan oil, and there's a lot of stuff, a lot of dynamics that are playing out. But obviously, there's a clear desire to increase our ability to produce and export energy, specifically oil and natural gas. And so again, that may encourage companies to start to expand production, which does help the oil service sector, which has really been dragging. But you notice during the last month, we started to pick up quite a bit. These stocks, if we start to increase our presence, increase the number of wells, et cetera, this is going to create some increased demand. You got Schlumberger on that list in there. I was looking at Bohr for a while until we started to ban offshore stuff. Then that started to get hit. But your naturals, Halliburton, you mentioned MPC. This is one of your bulls for the week. I mean, this is refining and midstream. Do you feel like there's going to be a boom in kind of demand for kind of that end stage, downstream products versus going upstream with producers?
I think it's going to be all of it, but I like this from both the perspective that we're going to be producing, demand is going to remain high. And again, it's if all whether it's through executive order or otherwise, if we see that we're going to reduce regulation, then all of these guys win. And the price pattern on that, the reason why this made
Yeah.
my list, you can just see that was such a great bull flag breakout or whatever you want to call the pattern. It was a solid breakout, and
Yeah.
the targets are easy, I think, on this one.
And you're
So
seeing movement in refiners. You saw VLO, you got PSX. MPC is kind of like when I look at refining, I generally go to MPC, but all these refining stocks are coming back. And if we look at RBOB gasoline plus /CL, we're just looking at a ratio of gasoline to oil. It's been a really tough haul as gasoline prices relative has continued to trend down. But maybe the move in some of these refiners, we're looking at maybe they're starting to break out where RBOB starts to outperform oil. And so again, looking more downstream. So I've been focusing more on upstream of late, Apache, integrated names like CVX. On Apache, we talked about taking profits here at the 161% projection. We talked about hedging CVX. It's virtually at our target at 165 off our low back here when I talked about the trade as a protected put. We're coming into earnings. We talked about hedging CVX before the earnings. But I like the idea of transitioning more towards looking at refining and again, service companies as an opportunity. And again, you look at top holdings with some of these funds or the refiners that'll help you identify some plays if you're looking for other stuff out there. But I do think the pressure, that the idea that oil prices are going to really come down dramatically to really matter a lot on inflation is probably an overstatement. I think Trump's being maybe a little bit overestimating his power here in some respects. And that certainly leads us to the Fed rate cut. I mean, so are they going to cut? The expectations? No. So if we look at the CME Fed Watch tool here, we'll scroll down here. So we look at Jan. Nobody's expecting a rate cut here. March, we're seeing a little bit of rate cut being priced in. So sorry, that is a rate cut. We're 4.25. Yeah, no, a little bit of rate cut there. May, we're seeing a little bit more of a rate cut. We get out to June, and June, we're finally starting to see a greater than 50-50 probability of a rate cut. But obviously, Trump talked about this week wanting to see lower interest rates, and by December, we're looking at maybe greater than 50% probability we get 50 basis points by December. That's 2 rate cuts this year, down from 5. What do you think the probabilities are the Fed is going to really start to get dovish at this stage with inflation where it's trending?
well, there's just no data that would support it. I don't think the data supported the cuts though last year. And
Sure.
so, and one of the comments was that we're every reason to believe it will be worse in this episode. Please understand, I don't care at all. I am so disinterested in whether people love Trump or hate Trump, whether they love Biden, hate Biden. It has nothing to do with your party, has nothing to do with your biases here. We're just talking about econ. Economic data would say that tariffs are inflationary. Economic data, and I'm not talking about 4 years, I'm talking about hundreds of years. Tariffs are inflationary. I'm talking about the idea that the oil production is production and demand. That's it. Please understand, we are talking pure econ. I don't care. I really don't
Yeah.
about your politics as far as either way. I don't care whether the last guy did good or not. I'm saying from right here, from this moment in time, what does the econ say? And as we're looking at these, I'm not speaking against the person you love or hate. I'm not. I'm saying the econ says this, and the econ says inflation is still here. Inflation is still holding up. Tariffs will add to inflation. And if we're cutting rates, that's going to add to inflation further. And I just don't see the justification, the numbers to cut rates unless oil prices drive so low that it pulls the entire inflationary number down.
Yeah.
And that would be the catalyst that would do it.
And the reality is, I mean, when oil prices were in the 20s to 30s, oil companies were in dire straits in 2020, right? A little bit of demand fell off, then a big fall off in demand. They're in a very, very bad position. It's take years to kind of recoup the earnings side of it. So it's got to be balanced. But again, government spending is inflationary as well, right? So the idea is that we have very high government spending. So tariffs, in addition to all the other taxes that we have, diminishes our ability to pay. But again, what's going to happen in terms of lowering taxes and other stuff to offset the rise in taxes on tariffs? And what's the pass through? There's a lot of uncertainty, which speaks to our point. We can't wave a magic wand and say we're going to lower interest rates. We can't wave a magic wand saying oil prices should be lower. But hey, if we can really start to ramp up production, oil prices will go lower. Inflation might go lower. Interest rates may go lower. So that's what we're watching for here, right? And so right now with the TNX, again, we're kind of at a point where at a critical level, we got a little bit of a bounce back the last few days. We push towards 4.8 or 5%, or we start to see yields come in. This is going to be a big deal in terms of looking at the outlook of the economy and the outlook on inflation. Those are the two biggest things that drive longer term interest rates. So I'm really interested to see, do we get a pivot point lower here in yields or higher? Higher could be very problematic for the market if we get pushed towards 5%. That's kind of
It's
a
a
big
dual
threshold.
mandate, right? It's a dual mandate. How's inflation? How are jobs?
Yep.
That's it. How are inflation? How are jobs?
All right, so let's get to bulls and bears. So again, for those that are talking politics, Blake only had bullish trades on his list.
Yeah.
So we're trying to be pragmatic, but look, I mean, a lot of the stuff we've been looking at is really on the bullish side. I threw a couple of bearish trades that I talked about last week during my session, Trends Friday, but we talked about MPC there. What about Upstart, Blake?
Yeah, no, just a lot of they've been discounted or have set up in a way that I feel like they are manageable. And Upstart had a solid day yesterday. We gapped down, closed higher, erased all the bearishness overnight. It is a weird looking inverse head and shoulders, in my opinion, and we've broken free. So I've got another probably $5 to $8 move higher. Minimally, I've got 75 on the radar, but I think we could go for 80. And if it goes for 80, you've got an $11 gain, and that's just shy of 20%. So we'll say 18, 17%. So there's an opportunity in there.
If the S&P is going to grind here, you're going to start to see the shorts get squeezed, right? Upstart is the classic gamma squeeze, a short squeeze stock. Basically, you'll see call option buying leading to a short squeeze. That's why you get these big moves, right? So this could be the beginning of it. I was looking at Purple Mattress last week, in part, and that again, this was all about a short squeeze, and we started to get it yesterday in Purple Mattress. I didn't put it on my list, but I did talk about Trends Friday last week. This was one of my picks last Friday, along with some others. But I like the Hormel trade. That's when I had on my magic formula 2025. What are you seeing with Hormel?
It's funny because Hormel and Smuckers and there's all these little companies that think, okay, why are they so low on their prices?
Hershey.
and what I'm seeing is, well, no, Smuckers and Hormel also have a good dividend as well. And so I like them as a dividend trade, a dividend aristocrat for Smuckers. And I'm seeing this bullish engulfing candle there. And
Yeah.
again, upside targets 32 and 34. It might not seem that far away, but that's a 10% increase plus a dividend.
A little stick sandwich in Smuckers, right? Put a little
Yeah.
jelly in the middle here. That's
I call
strawberry,
it
by the way.
I
Hey, you
call it
break the high,
the pistachio Oreo. So
but it's not red. But yeah, I like the idea with some of these defensive stocks. You got dividends. Hershey's on my list as well, kind of fitting in that this company has about 1.5 last trailing 12 months, $1.5 billion in free cash flow, and they're only paying about $1 million in dividends. They're paying close to a 3.5-4% dividend yield right now. Again, these are the setups if you're a dividend player. These are things you want to look for, right? You could wait for theirs to come out, wait for a positive reaction, and then buy, or buy and buy put against it, right? To reduce the downside risk. Sim, let's take a look at SIM here. What are you seeing on Sim? No, that's wrong. I brought the
I
wrong
was gonna
one. What is
say
it?
that
I
was
was
not
like, I didn't know what it was. I wrote it down. That's not right. What is what did you put out
now
there? Yeah, I
now
forget.
you
Oh,
now you
whatever.
make all right. You go
So
to
I
yours.
got I
I
got
don't know which one that was supposed.
AO
That was probably supposed
Smith.
to be Smuckers. That was probably SJM.
Oh, SJM. There we go. That was
Yeah,
Smuckers.
yeah.
Look, I mean, with all this stuff going on with Trump and potential tariffs, obviously it's going to have an impact on China. It may lead to more stimulus. So one of the undervalued stocks, one of my top 10 undervalued stocks for 2025 is Baba. We're kind of leaning higher this morning, up a buck pre-market, looking for a breakout here. Now, again, these are stocks that can make big moves. You could diversify with something like a K-Web, for example, or look at Baba individually. I am looking for the possibility Chinese stocks might make a second move higher here. Not super encouraged, but break the highs in Baba, pretty good value stock. AO Smith was one back here. I was talking about we got the breakout over the course of the last little over a week. Again, this is a dividend aristocrat, does not pay a big dividend, but it is trading at a pretty good valuation. And so we're looking at 82.50 here on the upside. Did break out over the last week. Again, looking for that kind of flag breakout and carrying it towards the trend target of 82.50, maybe 92.50 in AO Smith. And again, PayPal is one that, again, I think it's relatively undervalued. If the earnings forecasts hold, earnings are coming out. So you can wait for earnings to happen. Look for the breakout. Look for it to beat, raise, and break through the resistance up here. And you may have a bigger move in store. Again, looking at potential 128 up here off the big longer term downtrend on PayPal. But again, there are bullish opportunities and there's more out there. But as I talked about last week, Apple was my bearish trade from last Friday. Broke through support. We tested 220. Look for another break at 220. Apple's one of those stocks, those Mag 7. I think, tariffs are going to shift earnings towards more smaller cap companies. It's going to hurt some of these stocks. They're going to have to pay the tariffs. They bring stuff back in, and they do have earnings coming up. It's a big earnings week next week with Google, Apple, and the like announcing next week. And then I'm going to throw out Five Below. This is one that was talked about last week. We're looking for a break below the support, targeting our lows at 63. And why not just look for a continuation in stars? This is Constellation Brands. A huge miss here. Looking for a break of support, carrying this lower. Sam was another stock on my beverage list last week that was bearish on. It dropped pretty decently yesterday.
I
And
haven't looked at those guys in a long time.
Diageo, looking for this to roll over here at kind of at resistance, maybe breaking above it. Starts to take out yesterday's low. We could really roll back to 115, 114. So those are some consumer defensive stocks I'm bearish on.
Hmm. Yeah, and I just was going through and I just didn't see anything to get super bearish on at all.
It's
And
hard.
again, you got to go with what the chart says, and I like those. I think
You know,
Las Vegas Sands could be one
yeah,
consumer staples that would be or discretionary. Excuse me. I like that breakdown there, but
yeah.
it
Earnings
just
coming up.
didn't normally meet my rules
And
but
sometimes it's not always about, getting bearish per se, but getting defensive. And one of the easiest ways to get defensive is by taking profits. So we've had a big move here. I mean, scrounge around, right? I mean, look for that spare change in the couch to take profits, right? Look for those trades you can maybe trim some of your positions on. or possibly even hedge. The VIX right now down at 15, and you could buy a 20, 30 VIX vol spread for like a March, for example, or February, probably very cheaply at this stage. And if we get a pop here, it'll provide some insulation if the market unexpectedly downturns. Again, I'm kind of looking at this maybe peeling back here a little bit. So
Yeah, not, I'll throw out just one other thought process. If you're not ready to take profit on these ones that are highly extended to the top, consider just selling it if you're in the stock, considering selling close to an at the money call. You get
yeah,
paid the highest time decay and it lets you kind of hedge out your position while still participating in a little bit of higher move. So,
and you can even take some of that, and if you're selling at the money, take maybe half it. So okay, I'll buy a put below it somewhere,
yep, there
half
you
that
go.
premium.
Well,
Man,
we're out of time here, Brandon,
there we are.
believe it or not.
We got to give it
It
to
is,
Don. He's listening. He's watching. He's waiting.
he's always watching, always lurking, always judging.
That's right.
So,
Those are his words, not ours.
yes. All right. Thanks for being here with us today, everybody. It's there's a lot of uncertainty and it's hard to decide what things are going to be because these are things uncharted territories and there's going to be opportunity across the board. So just keep your powder dry. Like I said, have money available to trade and it'll all work out. We'll be able to find the next opportunities in the next move. So
Absolutely. Have a great, folks. See you, Blake.
see ya.